Folks, I know you're excited because I certainly am. That's because we've got positive news to talk about today. No one thought it was possible. No one thought I'd be talking about positive news today, but here I am. We're talking about Crowdstrike earnings, and as you can see, resulted in around a 12% gain so far when you're looking at pre-market trading. Crazy, crazy stuff. And why is this crazy? Well, the majority of the tech industry, especially when you're talking about these lower profit companies with much higher valuations, they've been getting hammered. Now, CrowdStrike doesn't share the same story as them. When you look, actually after today's gain, this is a company that is really relatively flat over the last year. It doesn't really share that same story that a lot of these have had. Now, in the last, since November, there's been a decent dip. But over the last year, a lot of these companies are down 30+%. So to be flat is a big win for CrowdStrike, and it's still trading at a massively high valuation. We're talking about a market cap that after today, that's going to be a massive boost to it. So just think about this. It's going to be around close to $47 billion market cap, right around there. And this is a company that last year only made $874 million. Now this year obviously made over $1 billion, but that's still, we're talking about 30 times on the valuation, close to that. Companies don't trade like that right now, so it's crazy that CrowdStrike's able to do this. This has truly been one of the diamonds in the roughs here. Diamonds in the rough as far as the stock market's concerned, I suppose. And it's something that actually has been somewhat prevalent throughout the industry. You look at a company like Okta, this one's been hit pretty hard, right? This is one of the few that's been hit hard in the industry, and doesn't share the same fate that, let's say, you've seen with CrowdStrike. But how about someone like Zcaler? I don't know. You think I would learn how to pronounce it, but we don't learn how to pronounce things here. Now this boy's actually been up 18% over the year. So a wide range of results really in the cybersecurity industry. But CrowdStrike falls somewhere in the middle, but really outperforming the market in general, all things considered. So let's look at these earnings. Again, the only way in this market that you're going to see a bump like this, a big move upward like this, is one way. It's going to be your guidance. It's the only way right now. Guidance is the only thing that moves the chains right now. I mean, right now we're sitting on 4th and 20, and the only way to move the chains is by superior guidance to analyst expectations. Otherwise, turnover on downs every time. Just telling you. That's how it goes. And then you're going to give up 6 the other way. That's just kind of how it goes. So looking at these earnings, I'm pretty impressed, right? Non-GAAP EPS line, 31 cents, beats by 11 cents. Again, need to see the net income line. Not a company that's historically known for making profit. So revenue came in at $431 million, which is up 62% year over year. Really, really nice, and a nice beat here by $18.6 million over the consensus. Now that's obviously pretty nice as is, and you can tell that it's really nice. But here's kind of what there's many other things that are bolstering these results that we need to talk about. Record annualized recurring revenue at $217 million, with growth accelerated for the second consecutive quarter. Now that is massive. Record net new annualized recurring revenue. The great part about this, as it being a subscription company, is this is money they can count on every single year. They don't have to work for this money, right? They've earned this subscription. They just have to keep their software rolling. I mean, they just have to keep doing their job, and they're getting this money without having to sell a good. I mean, they're not selling goods; they're selling services. So that's part of the benefit there of, I guess, services, I should say. Ending annualized recurring revenue is up 65% year over year to exceed $1.7 billion. So you can see on a 12-month basis how that continues to grow because they didn't put up $1.7 billion in sales this year. But it's going to continue to grow, and that means next year, if they just kept what they had right now, they're putting up $1.7 billion, which is already good growth. But if they continue to grow clients, or really increase the revenue per client, they're going to continue to do massive things. Excited for them. So, record operating free cash flow, pretty nice to see on that aspect. Hi doggy, hi buddy. And here is the main story of the day. Quarter one outlook, way beyond expectations. 558 to 465 million versus a consensus of only 440 million. Right, this is a massive beat on a guidance perspective. Where you're talking about 20 million over the guidance, that's a massive perspective there. Yeah, I mean, you know, it's significant. I don't know what else you want me to say. I don't know. 5% increase over the guidance is beautiful. That's all I'm telling you. Non-GAAP EPS of 22 cents to 24 cents versus an 18-cent consensus. So even that, nice. Would like to see that line increase a little faster. Obviously, you knowing me, but that's okay. For the full year, another massive beat on the consensus here. Total revenue at 2.1 to 2.16 versus the 2 billion line number. And a non-GAAP EPS of $1.03 to $1.13 over 94 cents. So again, these are massive boosts here from the norm. Okay, really great stuff. Let's look at the press release, see what we got rolling. Nothing super crazy that we did cover here, obviously, in terms of the numbers, but we'll get into some of the full year numbers here as well. We pretty well saw everything for the quarter besides this net income line, which I want to see. Net loss of $42 million. Now, not great, especially when you look at $19 million of loss in the first or the fourth quarter of last year. So actually, technically, they grew the loss in that line. Not exciting to see that. You'd like to see them not going in the wrong direction. But on a non-GAAP basis, they nearly doubled the year prior, so there's positivity there. I mean, it's tough to say. I don't know, but I'd like to see from a GAAP perspective they post profitability. That's what I'm shocked about, the stock really still hanging where it's at. It's crazy. Revenue, though, for the full year came in at $1.45 billion. So again, we'll look at that and compare this to the market cap here, especially because the market will be opening here in a few minutes. Subscription revenue came in at $1.3 billion. Obviously, that's the majority of their business. Not shocked, which is up 69% year over year. Really nice to see. Subscription gross margin came in at 76%, compared to 77% of the year prior. Again, this is a massive margin business, so in the future, as they develop, this is a company that should be able to really churn out net income like crazy. Should be able to print money. When you're talking about a gross margin of 76%, it's wild. It's crazy to see that. So really excited for the future of them when it comes to really this net income line. For the full year, came in at 234 of net loss, 234 million of net loss compared to 92.6 of the year prior. So definitely headed in the wrong direction. We're talking about really right around 2.5 times. It's pretty disappointing in my perspective when you're talking about the prospects for the future, because they're seemingly pretty far off, especially when you look at the guidance for the first quarter already of next year. They're pretty far off in terms of profitability, which typically means you're going to get eaten up in this market. I just normally revenue gain isn't enough anymore, but they've been lucky, which kind of scares me. I got to be honest. It scares me for the stock's performance in the future. Again, given this line here, I don't know. Recent highlights, nothing incredible on the recent highlights, honestly. These are all things that just happened throughout the quarter that were not necessarily good or bad for the business, but a lot of them are just things they did, so good for them. We did see the guidance, obviously, here. Significant numbers in the guidance. We'll look at the balance sheet real quick, then take a peek at the stock. Let's see, it's right here, baby. A little small. We'll zoom in. A little blurry. Maybe not too much, okay? We want to be able to see the whole thing. Total current assets, this line here, you see we're compared to year over year, 2.5 now sitting against a 2.3 number There is growth there. Looks like mostly in this accounts receivable position. Nothing else crazy, all things considered. Total assets of 3.6 compared to 2.7. That shows some pretty nice growth. $900 million of growth there. A lot of it in this goodwill category, so nothing too wild. And from a liability standpoint, current liabilities at 1.4 to 863. That's quite the difference in comparison to what the current assets look like. Quite the big jump there. Mostly this deferred revenue line. Total liabilities in general jumped mostly by what you saw in this current liabilities line, 2.5 to 1.8. The balance sheet's not in a terrible position, honestly. Over the year, they did grow the equity here, $1 billion compared to $871 million. They grew the equity. So where do I feel about this stock? What do I feel about it? Well, it's tough to say. We're right at 8:30, obviously, and it's showing no gain. So that's great to see. But come on, update for me. There we go. So what do I feel about the stock at a $43 billion market cap? Well, I don't like it. I hate to say it. I think I really enjoy what this company's doing in terms of growth. It's a ridiculously good story. But unfortunately, just given the market we're in right now, this is not the kind of stock I really want to play around with. We're talking about opposite of profitability, going in the wrong direction. It's to me, I don't like it trading in a multiple here. I mean, we're talking about a price to sales close to 35 at this rate. I mean, this is incredibly expensive for this market right now, even given revenue growth of 60%. I mean, I hate to say it. That'll slow down in the future, and when it does, I just don't know what that's going to look like. So that's what I got for you today. I hope you have a great day.